Welcome everyone to today's webinar. My name is Ali Mortazavi and I'm the head of education at Arante. It's great to see so many of you here eager to learn about an essential part of trading success, risk to reward ratios. Today we will dive deep into the topic beyond the basics to help you understand not only how to calculate these ratios but also how to leverage them effectively using TradingView. Very well. So before we begin, please confirm if you can see my presentation and you can hear my voice clearly from your end. So we will be able to continue this webinar more comfortable. Thank you so much for your cooperation. Okay, that's cool. That's cool. I'm getting a lot of confirmations from you guys. Thank you so much. So it seems everything is smooth and clear. So let's just continue. Okay, let me just bring up my TradingView here, where we are going to demonstrate all of the ways to use the reward to risk ratios here. Okay, let's just start with defining the risk to reward ratio. This ratio is a simple calculation that tells us how much profits we stand to gain for every unit of risk we are willing to take. For example, if we use a risk to reward ratio of 1.23, it means that for every dollar we risk, we aim to make $3 in return. And this concept is at the core of trading risk management, helping traders define the relationship between potential profits and potential losses. Well, for example, as a day trader, you might consider this setup here. A trader might, let's say, just underpin this strong resistance here, and then when they see a strong bounce back from this level, they might think for a sell position, and then in that case you will be able to put your stop loss above this resistance level here, and then calculate the reward to risk ratio for your potential profit targets. In that case, you can use the TradingView elements, or let's say features, to make it more visible for yourself. And please consider that it should be all beforehand of opening your new position, because we're going through different let's say very important calculations about our risk to reward ratio. This is a way that we will be demonstrating on the chart, but for now let's bear in mind that understanding this ratio is key to your trading success, because it allows you to set clear, realistic boundaries on risk and profits. This discipline helps prevent emotional decision making, which can often lead to costly mistakes. To make this clearer, let's consider a few common ratios. For example, a 1-to-2 ratio means that for every dollar you risk, you expect to gain $2 if the trade goes your way. Similarly, a 1-to-3 ratio targets $3 for every dollar risk. The higher the reward compared to the risk, the fewer winning trades you need to remain profitable in the long run. This is an important key. So let me just repeat it again. The higher the reward compared to the risk, the fewer winning trades you need to remain profitable in the long run. This is why experienced traders usually focus heavily on maintaining an appropriate risk-reward ratio for each trade. However, another tool that can be extremely helpful in determining potential profit targets and understanding risk-reward dynamics is the Fibonacci extension tool. Because we will see how the probability of getting to that high TPs can, let's say, decrease when you take them to a high or too far from your entry exit. On the other side, if you are looking for a higher win rate ratio. That means you need to somehow adjust your reward to risk ratio. So one of the very, very beneficial tools that you can incorporate with your trading strategy is Fibonacci extensions. Fibonacci extension levels are used to predict how far a price might move following a retracement. And these levels help you set realistic profit targets, which can be used to create favorable risk-reward ratios. And during the demonstration, I will show you how to draw Fibonacci extension levels on TradingView and use them to identify key price zones for setting key profit points. Here is a very, very simple tool. Here you can use the Fibonacci retracement on TradingView as the option to be changed from extension to retracement, and then you can add any level you really want. For example, let's take a look at this uptrend, let's say here. Okay, let me make a bit square to make it better. Okay, here if you want to apply, for example, Fibonacci 2 from this market bottom to this market top, okay, the one thing you can do is I'm going through this setting, and here you can choose all the different levels, which can be very beneficial to point the further support and resistance levels. And now we have all those retracements visible on the chart. You can see how the price reacts has reacted to these levels in the past. So, oops. Yeah, excuse me, let me just adjust it a bit to get a better picture from now. And that's it. We're all set. So see how the price has, let's say, after this completed uptrend here, it's reacted to all of these levels here at the 61.8% Fibonacci level, and then bounce back toward this 38.2 level, and then 23.6 level. And all of these levels could act as reliable support or resistance levels. You can see the bounce back, or maybe a breakout that can trigger that could trigger, let's say, a trading setup for us. For example, one might consider this breakout here after reacting for some time to the 50% level of retracement level of the previous uptrend here, and then that could be a good maybe entry point with the stop loss above this level. And now so you see how, for example, Fibonacci extension, this is one of the many different ways that you can incorporate Fibonacci tools in your trading strategy. So these levels help you set realistic profit targets, which can be used to create favorable risk-reward ratios. And during the demonstration, I'm showing you how to draw Fibonacci extension level in TradingView, as you see here, and use them to identify key price zones for setting take profit points. And in that case, if you want to measure that, for example, for a short, let's say, trade, you can consider breaking this minor bottom here, and then you're able to set your stop loss maybe above the 50% retracement level, and here you can adjust your let's say reward to risk ratio. That's here in the middle. You can see the risk to reward ratio is set for you by 2, So it means if the price falls to this level, it means for each, and you target this level, for each dollar you risk, you expect $2 in return. But you need to consider the probability uh, of this to happen, because probability is closely related to the risk reward ratio. I'm sure many of you, if you have any experience in trading, you know how to draw this and use this sell and buy positions, let's say projection levels here to set your TP or stop losses. But the one thing which is very important is the probability of that to happen, because it's closely related to the risk to reward ratio. You need to consider that a higher risk to reward ratio often means that you need fewer successful trades to be profitable, but it also may imply a lower probability of achieving your profit target in each trade. Conversely, a lower risk to reward ratio might have a higher probability of success, but it requires a higher win rate to remain profitable. It's important to balance the probability of hitting your target with a reasonable risk reward ratio. So, for example, if you choose a very high reward compared to your risk, you must understand that the probability of hitting the target decreases, which means patience and proper analysis are crucial for that. For example, in this example, if I somehow set uh, my risk to reward ratio to 3, which means I expect the price to move below the 61.8% and then hit the 78.6%. In that case, you see, I needed to wait for a long time. And also you see that the price bounced back sometime, and that hit my stop loss here. So that would be a very unrealistic, let's say, TP for me. So you need to consider, despite all the saying about the high reward to risk ratio, you really need to consider the probability of that. So you see, if you choose a very high reward compared to your risk, you must understand that the probability of hitting the target decreases, which means patience and proper analysis are crucial. And please consider that risk management is not just about numbers, it's about mindset. So the key here is to develop a disciplined approach to trading, understanding that losses are parts of the process. When you have a favorable risk to reward ratio, you gain the confidence to stick to your plan. So this is the first benefit of having this beforehand. You open your position, knowing that even if you lose a few trades, a profitable trade can make up for those losses and more. So discipline and consistency are what ultimately lead to sustainable success in trading, instead of considering only the high reward to risk ratios. And but here is another consideration: how the right risk reward ratio improves long-term success. So having a favorable risk reward ratio directly impacts your trading strategies, the statistical probability of success. If you aim for a 1-to-3 risk to reward ratio, for example, you really need to be correct about 25 to 30% of the time you stay profitable. To stay profitable. And this shows how having a well-defined reward to risk ratio allows you to maintain profitability even when your win rate is not extremely high. So you see how you can adjust your expectation about your targets based on the probability or the effectiveness of your trading strategy. Additionally, even a ratio higher then one-to-one can lead to successful trading depending on the strategy employed. I'm going to explain that to show you that it's despite all the saying that you have to go only for the very high reward to risk ratio, even one-to-one reward to risk ratio or a bit higher than that can be suitable and to can end up with a profitable experience trading forex. In such cases, consistent small gains accumulate, and strict risk management ensures losses are contained. How we can define that? For example, here is a very simple strategy you can use. Here you see I have a Euro GBP on my daily chart. So let's move to, for example, 1 hour chart. Let me just switch off the Bollinger Bands here for a more clear picture. And then trading as it's really important to understand the let's say the trend first. Okay, and then we can move to even 1 minute chart. Okay, here on the 1 minute chart we can easily use some of the predefined moving averages. Here this is a 100 moving average, and this one is the 20. I guess it is a 100, and the one is a 20 length moving average, which is a WMA. Okay, so what we have here, we have the price below the long moving average. Here it means it's a demonstration of a downtrend based on the theory, and then we can just draw this trend line by connecting two lines of this trend, this top and also this one. Of course, this is a tentative trend line because we don't have a third point, so we can expect the price to get to this trend line for the first attempt. And on the other side, we see the price now is in a correction movement compared to the whole downward trend, even on the 1 minute chart. What does it mean? It means the price after hitting this low wasn't successful to make lower lows. So, and we see this higher lows here, and eventually the higher tops. And now it's broken above this last market top here, and it's let's say it's triggering a buy position for us. And for that, this is a very, very probable scenario here that we, for example, could even go for a long trend to set our stop loss here at this last market bottom here, and then we have our entry here, and then we were able to set a 1-to-1 reward to risk ratio. In if we would have done that we had hit this target here. Okay, so this is a 1-1 reward ratio, and this is a very, very probable scenario to happen. But if I go unrealistically higher than that to set, for example, only 2-to-1, I need the price to conquer this very, let's say, somehow a strong downtrend line, which could be not very probable. Because in that case, I need more, let's say, confirmation from the price. It could happen, but for now, I don't have any evidence in hand to show that, to be confident that the price is going to hit this target. However, there could be a risk. So that can increase the risk for my trade. So in that case, you have to bear in mind that we are in forex market and we're going to stay here for the long term. So not making a profitable trade or making profit per each trade is the goal. The goal here is to stay in the market, to let's say protect our capital during time to succeed. Yeah, you see they have a reaction to this trend line here right now. So you see a certain high frequency trading strategies or scalping approaches, especially in this 1 minute chart or 5 minute charts, is a 1 to 1.5 or 1 to 1 ratio, but rely on a higher win rate. So here is how you can deal with reward to risk ratios. If you can define a very high probable trading strategy, you can just increase or adjust your reward to risk ratio to increase your win rates. In such cases, consistent small gains accumulate, and strict risk management ensures losses are contained. So understanding these statistics can empower you to approach trading more logically rather than emotionally. So let me share another example here. One of my colleagues who started trading with a simple 1 to 2 risk to reward ratio, let's say strategy, managed to stay profitable over the long run, despite only having a win rate of 40% by sticking to a disciplined approach and ensuring that every trade meets his risk reward standards. He avoided the common pitfall of chasing losses or letting emotions dictate his trades. This is proof that following strict criteria can help you succeed regardless of your experience level. And that's another reason about the importance of having the reward to risk ratio in mind. And right now, you see we have a break above this downtrend line, and we already hit the 2-1 reward to risk ratio factor here at this price level. So this is a case you see the price is let's say reacting to this level very sharply. We can find more examples here, maybe on the Euro USD, or even we can move to the gold. And here is it. You see how gold is, for example, dropping. And if you are, for example, a scalper, you can go for, let's say, hunting any reversal can be very beneficial. For example, here you can, if as soon as you saw the price hitting this neckline, it's the formation of a double top pattern here when we have a very nice divergence between the RSI and the price somehow, and then the price falling below the both moving averages with the converging moving averages. The short one is approaching the long moving average, so this is a good let's say sell setup for us. And also here is another setup that you can go for example, a short trade to put our stop loss here at the last market bottom, market top, and to project our TP to even to 1 to 3. So what does it mean? What's my goal of saying that? I'm bringing it up because I would like to point out that one of the other factors that you really need to consider when you want to pick reward to risk ratio is where are you on the chart. So if you are at the beginning of a new trend, this is a much higher probability that you will hit a higher TPs during the way, because this is just the beginning of a new trend, and the price can fall to the next, let's say, a significant key level, like a support or resistance level, and that's it. For example, even here, if you want to act based on the price action, you can choose this level based on a very strong support level here, and that could be your projection about your next 1:2.2 reward to risk ratio here. So if you are, you can see yourself at the beginning of a new trend, you can go for a much, let's say, higher reward to risk ratio. However, if you are not set for that, so you can consider first the all key levels like a support and resistance levels along the way, to the down, to the on, to the upside, in your favor, so you can set your TPs there. So all I'm going to say is that you need to check your expectation with the chart and with the price setup, and you can go just blindfold against the chart and to set, for example, 3-to-1 reward to risk ratio setup when you don't see, uh, you have not checked, let's say, the key levels, and that can impact the probability of the reaching your targets very seriously. So a risk to reward ratio are one piece of broader trading plan, which should also include proper analysis, entry and exit strategies, and position sizing. A solid trading plan not only outlines potential rewards, but let's say also considers risks in a systematic manner, incorporating well-defined risk-reward standards is like setting guard rails for your trades, keeping you within safe boundaries while allowing room for profits. Additionally, understand the risk to reward ratio directly impacts the expectancy formula, which is measured of how, which is a measure of how much you can expect to make on average for each trade. How many of you are already familiar with expectancy formula? I'm really curious to know that. So please write it down uh, in the chat box if you know you know expectancy, or you are going for it, or you are calculating your expectancy. That would be very helpful. Yes, that's cool. I see some of you are familiar with that. Expectancy is calculated as probability of win uh, rate, actually multiplied by average win minus the result of probability of losses multiplied by average loss. So by maintaining a positive risk to reward ratio, you increase the chance of having a positive expectancy, which means your trading strategy is likely to be profitable in the long term. By the way, you can see, the TradingView is an incredible versatile platform, and one of its strengths lies in its visualization tools. Yeah, we use this some of these tools today to illustrate how to set up and assess risk to reward ratios for any given trade. And these visualization tools help you to see the bigger picture, where your entry points, stop loss levels, and even take profit targets, or and understand if a trade setup is worth pursuing based on your risk parameters. So let's dive into TradingView again. And first, I will show you how to create a basic trade setup. We'll begin by choosing a trading pair and identifying, for example, potential interest, stop loss, and take profit levels. You will see how easy it is to visualize where your risk lies and where your potential reward is positioned. For example, besides that, let's move to another instrument like you name it. If you have an instrument in mind, you are you want to check on something, just feel free to ask. Okay. Okay, here, oh, let me find a nice setup, maybe. Okay, I think we can go with this GBP USD for now, as we see the price is trending downward. However, there is a pause during this downtrend by making this higher low here. So one setup can be, this is an analysis when the price actually crossed above this 20 moving average, means the short-term positive momentum is gaining. So we can expect the price to hit this last market top here as a very strong resistance level. And if it can't cap the gains, it means we gonna approach the 127.20% Fibonacci extension, and then 161.80, and then 200. And what does it mean with 200 Fibonacci extension? It means this is a 1-to-1 reward to risk ratio. This is the first thing. So and if you wanted, for example, to trade this, I would say one of the most practical tools on TradingView is the risk reward ratio box. Let me guide you step by step on how to create one. The risk reward box visually represents how much you are risking compared to your expected reward. By adjusting this box, you can easily see if the potential trade is meeting your criteria for, let's say. And even if you want to trade, you can set your targets here, and you can use the stop loss and your TP, and then you can see here your risk and your reward based on the percentage of your let's say of your capital. Yeah, this is a one way if you want to be very fast on that. However, the box I was introducing was this, the long position and short position. For example, here for this long position, I can set my entry here, it shows my stop loss here, and it shows my TP here. And this is a one, let's say, reward risk reward ratio here. So easily I can see how much I'm going to risk. For example, this is a 0.4% stop with a 55 points, and the amount would be 750, and here the amount would be 1250. The same, let's say the same ratio, and the reward to risk ratio is 1. So this it means by ending this downtrend here, we can expect the price even going further toward the longer moving average, which here is 100 WMA, and that's the case. It can give us the expectation of hitting this 1-to-1 reward to risk ratio. And again, it's not a bad reward to risk ratio. It's just about the probability of hitting that target or reaching this target, which is in that case, if we, for example, set our mind with this strategy, we can expect to have more successful trades with a lower reward to risk ratio, but eventually we will have something like a higher win rate. And in that case, we can end up with again, positive expectancy. So it's useful to standardize your risk reward box settings across different strategies. For example, you might use a 1-to-2 ratio for trend following strategies and a 1-to-3 ratio for reversal trades, or for some to trade these small retracements, or let's say these very short-lived retracement waves. You can use a 1-to-1 ratio, and having this standardized visuals helps you make quick, confident decisions without second guessing yourself. So let's now talk about alerts. Alerts are critical for ensuring that you don't miss out on trade opportunity to match your risk reward requirement. I will show you how to set up an alert in TradingView so that you're notified whenever the price reaches a level where the trade meets your predefined criteria. Best practices for using alert effectively without relying on constant monitoring. Let me break it down here. One of the best practices as a support tool, not as a crutch. Instead of monitoring your chart 24/7, set alerts at key levels, entry points, stop loss triggers, or the take profit level. And this way, you can ensure your trades align with your standards without constantly watching the screen. For instance, you have identified a strong support level and your risk reward ratio looks favorable, so you can set an alert to notify you when the price is close to that level. And this gives you, let's say, time to reassess the trade setup without missing the opportunity easily. You can go here, so you see this clock icon here is for alerts, and so here, for example, you can set any alert you like on this instrument. And it's not just to choose a price level as a condition, it's also possible to choose one of these indicators that you have active on your chart layout, which means it demonstrates your market analysis approach and how this is a technical, these are technical tools that you are using on your chart. So you can also set the alert for the price hitting any of those, or even you are looking for any kind of crossover or something like that. So for example, here in this condition, I'm using the price, and then you can choose what type of alerts you like. It can be crossing up, crossing down, greater or less, or entering a channel or exiting a channel. Any of these you can set. Let's stick with crossing, and then you can set a value. This is a price level that you want to get alerted when you see the price, for example, crosses this level. So you can also choose to trigger it only once or every time. And also, besides the value, you can choose between any of the other indicators you have active on your chart. For example, it can be Bollinger Bands, can be any of the moving averages, or even Ichimoku system, or then, for example, let's say WMA 100. So you can get notified when the price hits the 100 moving average here, and that's a very interesting part of this setting alerts here. So it can be at dynamic levels. It's not just only the static price levels. So you can also set it the number of times you want to get alert, let's say notified, that alert will only trigger once and will not be repeated. Or here you can choose that the alert will trigger every time the condition is met, but not more than one time per bar. It means if this bar hits the moving average and then being volatile around this, it's not gonna bother you. It's a multiple blindfold somehow alerts. So you can also set the expiration date on that, and you can put a name on that, and in that case you will be able to use a different alerts without any confusion. And this is a message you really want to get as a notification here around the let's say this down corner of your TradingView platform. In that case, you can easily create it. And when you create it, you see that we have the active alert here, and as soon as we miss this criteria, we get notified by that. And this is another way. For example, you might want how and when this is how you can set an alert. And when you are when we are going to use that is when we want to find a better price to enter the market. For example, let's get back to the chart here and see. For example, you see the market is in a range bound somehow here after all of these fluctuations with no direction, and then out of a sudden you see this crossover between the 34 and 100 moving average while the price is pushing down further below both moving averages. And then when you see that, you might want to get a confirmation, and the best confirmation after the price crossing the moving average is the let's say bounce back to the cross moving average. And in that case you have the 100 WMA. So here you can actually set an alert for yourself to see if the price hits this level, and then you can find out how we have this very nice shooting star here, and then we have this downside gap here. This can give you an entry with a very good reward to risk ratio. Even if you enter here at this level with less confidence, you can set your stop loss here, and that would be very easy trade to manage. Let's say for a short position, for example, you can enter below the setup, and you can set your stop loss easily here, and you can have any, let's say 2, 3, 4 reward to risk ratio, and this is a one case scenario. And then also you will be able to set or to have another entry maybe here when you see a break below this last market bottom, so that gives you a more confidence about being in a downward pressure. And then you can set your reward to risk ratio maybe with aligned with this lower boundary of this range bound, let's say, the probability. And also then you can have another one. But here you see with setting these alerts, you can get notified as soon as the market meets your criteria, for example. And in that case, you can just evaluate the trade before you enter the market and getting out with regret. So in that case, you can easily just identify, okay, here is it can be my stop loss, and here is my entry, so it's worth to enter the market or not. And I can set, for example, my reward to risk ratio even here at the lower boundary of this range bound. So this is a very, let's say, a significant support level. So that will be a thing that you see, okay, it gives me a risk uh, RR ratio of 3.25. So it is worth it. So you can enter this, open this sell position for that. And even you are wrong, you will hit this stop loss here, and you actually you will be again ahead of your plan. So that will be cool. So to summarize, we covered what the risk to reward ratio is, why it's critical for long-term success, and how to use TradingView to visualize and maintain disciplined trading setups. We also looked at the practical examples of creating and customizing these ratios and setting alerts to stay on track. Uh, So as we wrap up, we want to highlight a few key points. First, always stick to well-defined risk-reward ratio for each trade based on the chart setup, not your, let's say, your let's say isolated expectations. And this practice isn't just about numbers, it's about having the discipline to follow a system that maximizes your potential for success. And then predefine your projections, or let's say your potential targets, to see if the reward to risk ratio is worth to enter the market or not, and also see all the obstacles along the way to reach your take profits. And also make it a habit to use visualization tools like these in TradingView each time you plan a trade. So this will keep you accountable to your strategy and help you avoid emotionally driven decisions with and next is that with practice setting of these visuals will become second nature, helping you maintain a professional approach to trading. So lastly, I encourage you to keep learning. We'll have more webinars on advanced trading techniques, and I will share some resources where you can continue developing your skills. Thank you so much, all of you, for joining today, and I look forward to seeing you in our next webinars. Thank you so much and have a great day.